So one of the major drawbacks of doing what I do is you often miss the major market moves. Yesterday was a prime example of this. One of the challenges that we run into is the commodities market and the futures market, especially the gold and silver, dealing with the metals as we do, is that there isn't a real good time to really snapshot things, to freeze them for commentary or review or anything like that. Because we have to remember that anything that we're doing market related is 23 hours a day, 6 days a week, as opposed to 6.5 hours a day and 5 days a week for say the equities market or even the debt market. So it's always a challenge when all of a sudden you're sitting there and you're editing your commentary for the day. Things were moving along with the way that you thought they should, and all of a sudden you glance over and you're like, wow, silver just took a massive dive. And by massive, I mean more so than what it normally is. I kind of sat there and thought to myself, wow, should I redo this video? Should I delay it by a few more hours, or should I just talk about the next day? Here we are the next day, and you know what I'm talking about. As we dig in, the big thing to keep in mind, I've always preached on context. Context is everything. You have to look around at the bigger picture. If you don't, you're going to miss a lot of what's going on, and you're going to draw wrong conclusions. The more context that you have about what's happening, the better it's going to be for you. And this is no different. We'll actually dive into it, but just to kind of throw this up front, the reason for the dive was that Fed Open Market Committee. Silver got nervous, the same as a lot of the market did. There wasn't a real great day on the market yesterday. And a lot of it's because of the uncertainty of what's going to come out of the meeting that's going to be announced today. Without any further ado, let's jump in. Let's dissect what's going on today and see where it goes. And then we'll have to regroup tomorrow and figure out exactly where where the chips fell and how everything landed. So let's go. So as we look at the big board today, it's still early in the morning. We're not actually doing active trading yet, but we can see that it's mostly green. Some of it's a little bit darker red. What that implies is simply the market is tentative over where it was yesterday. The market's looking at where it closed at and really not making too many moves, too many gains at this early hour. So even the futures within the Dow, within the S&P, both of those are pretty low, about 0.1%, 0.15% on the S&P respectively. NASDAQ, Russell, they're both a little bit better, but not significantly. This is in light of some pretty decent earnings days that occurred yesterday. We did finish down yesterday on the major equities indices. Even with the earnings, we weren't really seeing that push. And a lot of the veil that's being thrown over everything is this Fed Open Market Committee. And I can't stress that enough, how challenging that is for trading at this point, because they're going to be doing a lot of discussion of interest rates, and especially the inflation that just keeps on creeping up. Certainly, they're going to be looking at a lot of the same reports that I've identified over the last couple of weeks with manufacturing. Not necessarily like durable goods that we had yesterday, but we start looking at manufacturing output. We start looking at supply lines, things like that. And there's some troublesome aspects here. So part of that is really what's kind of casting a pall over all of this. Even as we look into, energy, we've got gas that's down by 1%. Even everything that's up, with the exception of ethanol, is only slightly up. It's up by about 0.5%, maybe a little bit less than that, maybe a little bit more than that, but it's really there. The same as grains. Grains are just riding in that plus minus 0.5% range. And then we get into the metals today. Palladium and silver are actually up, but I'll get to silver in a bit. Copper is down by just over 0.25%. Platinum is down at 0.08%. And then gold, of course, is down just a hair by 0.11%. So there isn't a huge amount of excitement or anything else that's going on. There's also not a lot of negativity. Everyone's just holding their breath. Any moves that occur are going to be based off of news. They're going to be based off of events that occur, things like that. So we just have to be prepared. Looking into the reports today, we can see that the only big thing that we've got is the advanced trade in goods. That was released at 8:30 a.m. But the two big items here are Fed Open Market Committee announcement, and then we got Powell. He's giving a press conference at 2:30. Jumping into the 10-year Treasury, we can see that we had a slight uptick yesterday, which is almost in line with the fact of what we should normally be seeing. Yesterday, I spent a lot of time talking about how it's kind of moving contrary to where it should. Even as we start looking at this right now, we can see that, okay, we had a pretty significantly down day yesterday across the board. Things were pretty good in red. All of a sudden, we saw this slight uptick in this rate. We went from 124. That was the close yesterday, but now today we're actually seeing the 1.27. Take it for what it is. It's not a great sign. It's just kind of moving within the band that we expect. Maybe this shifts. Maybe this indicates a directional shift. It's still incredibly early to say. We don't know where it's going, but we can hope. We can kind of project on this and pontificate. The moment you've all been waiting for, the silver futures market. Let's dive in and take a look at this quick. We can actually see from the weekend out, this was kind of an interesting case. So from 820, we closed 25.29. We kept on going down a bit. We got as far as really 10 a.m. when we were right at that 2509 mark. And then shortly thereafter, by 1025, we were all the way down to 2474, and then we had finally bottomed at that 2454. So we had quite a range over the course of really 2 hours. From that period on, we had gone from 825 from the top, or 830 at the top, all the way to, what is that, 1205? We'll call it 12, just for the heck of it. So 3.5 hours worth of trading dropped that price considerably. The biggest thing that we can say is that the point there was, even at 2510 close at 1005, it was FOMC. It was Fed Open Market Committee, that as soon as they went into session, the price dropped, and it dropped considerably. Part of this is just that justification that I've been trying to really chat about for a while. Silver is highly affected by market aspects. There's a lot of market drivers, there's a lot of industry drivers. So when all of a sudden someone starts talking about inflation, they start talking about interest rates, things that would affect manufacturing concerns or industrial concerns or corporations, things of that nature, all of a sudden you wind up in a situation that the underlying commodity price is going to be affected by that, because it's not only going to affect what's happening now, but it's also going to affect future values, future orders, supplies, things of that nature. This is where it took a hit. So you had a lot of people that all of a sudden decided to jump in and say, hey, wait a second, I'm going to hedge my bets right now and get out of this commodity because I'm not sure where it's going to end. They don't know what the announcement today is going to be. So before everyone else does it, they decide to do it. As you start going on, all it takes is a few big guys to start selling. As soon as that occurs, you wind up in a circumstance where other ones start to look and say, well, I don't want to miss out. It's FOMO that kind of takes over. So you wind up in this circumstance where all of a sudden a couple of big guys decide to sell at that point. And then you wind up with a steady decline until it reaches, a critical point, which seems to be right around, 24.54. And that bounced back up. It just started making this slow progression back up, at which point, first thing this morning, it started touching the VWAP again. It started touching that -2 on the 5-day, which should be an indication. Whenever you have an asset, or whether it's commodity, a future, an option, an equity, debt, whatever it happens to be, whenever it's something that conforms this well to this type of chart, you have to look at it and say, okay, there's more than just market demand here. This is more than just supply and demand. So you have people that are deliberately moving a market to hit certain goals, hit certain targets. There are certain quantified aspects of this. As we start to look at this, we apply a couple of VWAPs. We're right in the neighborhood. We're seeing a lot of where this goes. And there's probably a couple more in there that actually exist that I just don't have on the board, that you can see exactly where these things are kind of hovering around and where they want to be. Traders get bonuses based off of this. Traders get bonused on VWAPs. If you're going to be making your money off of an indicator or off of a performance metric, you're more than likely going to try hitting that. And that's part of what we start to see. And it's not just with silver, it's not just with gold. It's with so many different equities and assets and, other tradable commodities that when you start to apply these things, you have to look a little bit deeper. You have to scratch the surface. We did have this momentary lapse where there was some profit taking, there was some protectionism that went on, and then all of a sudden it went back to the regime. It just went to the new regime of where it was after the adjustment. So things dynamically updated, and it went through. Gold, on the other hand, tells a completely different story. You know, we still see this was the that 10 o'clock hour that drop, but we don't necessarily see a significant range of what we were dealing with before. It's not the same as silver. There's different dynamics behind it, and it's not because gold is quote unquote less manipulated or anything of that nature. It's because gold represents a different segment of the market. Gold is much more aligned with financial services. And it's something that I've talked about before, that financial services aren't taking a hit right now as bad as where, industrial manufacturing, things of that nature are. Things that silver is primarily used for these days. You're seeing a resiliency to gold that isn't really necessarily in line with where silver is. And at the same point, we're still subject to these drops, but then we had almost same recovery. We went from, where was it, at 1020. So we have the high point here. We'll say it's 1803. We drop down to 1796, but then all of a sudden we're back up. We're at 1801. So we're not that far off. And before too long, we oscillated really throughout the day until the next opening. Early today, we jumped all the way up to 1807. We had another peak at, 1806, and then we just kind of declined a bit, bounced off the VWAP a little bit, and then, we're just kind of hovering where we are in that lower range. But gold is much more resilient than where silver is. And it's just something to recognize that right now there's a lot of bullish analysts. There are some bearish analysts, more on the longer term aspects of it. But there's a lot of talk about movements of gold. Compared to the two, I think that there are upsides on both of these metals. Silver has a definite upside because it is very undervalued. As the economy recovers, we're going to see that pop. Gold, on the other hand, I think that there's enough financial aspects that are going on within the financial community that it just makes sense to have to store whatever. But again, everything in moderation, everything to its proper place. And of course, if you don't know what you're doing, talk to a licensed investment advisor. I am not your investment advisor. This is not advice. This is my own personal opinion on these things. Use this for entertainment purposes only. Blah, blah, blah. The 5-day chart just serves to punctuate a lot of what I was just talking about. We can see the differentiation between silver and gold, especially as, we were moving roughly in tandem. Things weren't too far apart. They were moving together. Silver was doing pretty good for a while. And then all of a sudden we get to the high points. Silver was coming within a hair of really breaking even on the 5-day. But then, boom, it went all the way down, dropped as low as negative 3.41% on the 5-day performance, and that recovered slightly. And between both of them, they're both negative at this point, but you can see the wide distribution between the two pricing regimes and their performance. As much as it pains me, I really had to show you the gold-silver ratio today, because this just got ugly for a while. And we can see that, going through the weekend, everything else coming in, boom, that popped up. That was, 331 was the price for the spot-to-spot market ratio. Even down for retail to retail, we're seeing 64. Those are ugly numbers. But part of it all of it has to do with the strength of gold versus the weakness or the vulnerability of silver at this point. Looking into retail silver now shouldn't be a big surprise. Everything's been on the decline. 1 ounce generic is really rapidly closing in on the weekly basis of that $30 mark. It's currently at $30.09, but we can start to see where these levels are starting to approach. It's a good buying time. But let's look at the momentary on the generic and just quickly going through and seeing this. Interesting moves occurred. We're at $30.09. Which is where, if you recognized up top, that was the average then. we were seeing a median underneath that $30 mark of $29.86, but we had a low all the way down to $29.32 and a high of $31.32. Now, if we look all the way down at its lowest point, the low price that was recorded was $28.56, that average of $29.38, and of course the high of $30.61. So the prices are definitely down from where they were a while back, but even as we start looking at where they are now and where they tend to be moving, even at the 9 o'clock when I froze this, we're seeing that, the average price is under the 30 for the momentary right now. So we're at $29.61, and on current data as of 9 a.m. this morning, low prices are $28.78. The median is pretty decently down underneath the average. So there's almost 20-point spread. There's 19 cents. So it's $29.42 on the median. So you're finding a lot more that are going to be on the lower end of the spectrum than on the higher end of the spectrum. And then we get into that high price of $30.83. So there are deals that are out there. Your best bet is going to be to look to the online dealers if you're looking for a decent price. Search around. You'll probably find them if you're looking to do some acquisitions, especially at this price point. Retail gold is, again, kind of holding on, although there are some declines. We can definitely see the steps that are occurring. We have last week was a little bit higher because we were on that upswing for a couple weeks. Now we're having kind of that off week just because gold hasn't really continued to appreciate. It's dropped down a bit, but it's still holding pace and it's still strong. We're at 1889 for a 1 ounce generic gold. Although scanning the groups, I've seen, at various social media groups, I've seen people selling, mid 1800s on 1 ounces. So if you look, the prices are out there. You start looking at some of the premium ones, such as the Kangaroo, that's under 1900 on average now. The Cougarand isn't, it's still above at 1902. You'll get the Philharmonic 1905. And then, of course, you look at, start moving into what I'll call the super premiums or the much more desirables and more common. The Maple Leaf at 1923, the Gold Eagle at 1962, and we still have the Gold Buffalo that is just hanging on just by a sliver over the $2,000 mark at $2,000.92. You look at all of that together, and the prices are starting to come down a bit, but they're definitely not coming down as fast as what anyone would expect. And there's still a significant amount of premium that exists, especially when you start looking at these, high-end super premium, the American issue coins, the Canadian coins, and then you start looking into the other sovereign mints. So if you can find it, it's good to do. If you can buy it in a little bit larger quantity, that's better. The premiums are less onerous, as you can definitely see. If you buy 1/10 ounce, you're paying $2,700 per ounce. Whereas if you're buying a Buffalo for 1 ounce, you're paying $2,000. You can save yourself $700 by maybe waiting a little bit longer or doing something else or whatever. It's just better money. And the better that you can get into these things, the better you can get out of them. Hopefully that provides a little bit more context for you on what's going on, what happened today, where everything is, what we're looking at, and really everything else about, the markets that we like to play in. Anyway, that's what I got for today. If you like what I'm doing, feel free to like, share, and subscribe, spread around to your friends, whatever. And until next time, happy stacking.